We'll start with reading 17 of the CFA Level 3 curriculum that talks about capital market expectations. So up till now, we've understood the requirements and the needs of our individual clients. We've likewise understood the needs for institutional clients, and we now need to go ahead and start constructing a portfolio for them. We know the required return, we know the risk tolerance. But before I decide what to do and how to go ahead, I need to have some expectations about what different asset classes are expected to provide. So I need to formulate some expectations about the return from debt, about the return from equity, about the return from venture capital, so on and so forth. And then I will be able to go about combining these expectations with the requirements of my clients into a portfolio or into an asset allocation. So in this review, we just try to assess what the market has to offer, what different asset classes have to offer. So we'll start by understanding and formulating capital market expectations, see various forecasting tools, understand cyclical analysis, a review on monetary and fiscal policies very briefly, understand the linkages between different economies, how do asset class returns behave under various economic conditions, and wind up by understanding some theories about forecasting exchange rates. So macro expectations are expectations regarding different classes of assets. So they are more broad based, and this is what the topic of discussion is going to be today. Micro expectations come from a more bottom-up analysis and are expectations regarding individual assets. So one particular stock would be a micro expectation. The stock market as a whole would be a macro expectation. The process is to first determine which expectations are needed depending on the requirements and depending on the kind of investing I'm expected to do. Investigate the historical performance of that class or of those sets of classes and determine what are the drivers of future performance or what are the determinants of the performance of these sectors. Identify the appropriate valuation model and understand the requirements of that valuation model. So if you're using a DCF model, then we need a return on equity as an input. So we need to have some estimate or some expectation about the required return on equity. Similarly, another model may require the expected return on debt. A relative valuation model may require the P valuation of the index, so on and so forth. So identify a valuation model, collect the best data possible, condition the data for current investment conditions. So generally from your experience and judgment, you would know that the historical data and the historical analysis that you have done may need to be tweaked for the situation that we are in currently or for what the conditions are right now. So we would use all these steps to finally formulate our capital market expectations. Always remember to monitor your performance and to use the performance to refine the process of whatever you're doing. Please understand that high quality forecasts are consistent, that is, repeated calculations and repeated methodologies will give us the same answer. They are unbiased, objective, well supported in theory and research, and have a minimum amount of forecast error. Now there are many problems that come when we are doing this process of forecasting to get to our capital market expectations. First and foremost is the limitation to using the data itself. A lot of times the data that we will use on industrial production, so whatever data we are using, GDP growth, inflation, industrial production, etc., normally comes from some government source or some ministerial source, and often this data is late, often it is revised upwards or downwards. So there is some limitations to using the data itself. Timeliness is not there, there are errors, indices at times can be rebased, so historical comparisons are meaningless. There can further be transcription errors, survivorship biases in our data, appraisal data which is artificially smoothened. So we studied these concepts In brief, at level 2, we'll just quickly revise. Transcription error is just a mistake in taking it down. So somebody said 10.0 and you noted down 100.0. Survivorship is that only the survivors are coming into our analysis, hence our returns are biased upwards. Appraisal data is when I don't have a liquid market. A lot of times the valuation is an estimate, or the valuation comes from the last transaction which hasn't happened in the last 3-4 months. So there is artificial smoothness in the data, not because there is no volatility, but just because there were no transactions. Non-stationary data cannot be clubbed together. So if you're trying to predict India's GDP growth, then if we club the last 50 years of data together, we'll be making a mistake, because for all practical and economic purposes, India was a different country before 91 and was a different country after 91 when the deregulation and the reforms happened. So if the regime itself has changed, then the data should not be pooled together. This will come at the expense of having a large sample. So often in trying to get a large sample, we may be susceptible to this error, that is, we pool in non-stationary data. Ex post data may underestimate ex ante risk. So ex post is after the event and ex ante is before the event. So we find by historical analysis that the PE ratio of this stock was just 5 times. So on January 20th of 2002, we calculated the P by E ratio of the stock. So the price on this date is known to us. All historical prices are known, even today's prices known. So we were calculating the forward P by E on January 20th. The stock price was known, let's say it was $100. And the earnings at the end of 2002 are also known because we are in 2013. So in 2002, let's say the earnings actually were $20. So when looking back, I calculate the P by E ratio, I will conclude that the PE ratio for the stock was 5 times because the stock price was 100 in a year when the reported earnings were $20. Now this analysis may be incorrect because on January 20th, 2002, did the investors know that the EPS will come out to be $20? In fact, at this point in time, the expectation was that the EPS will only be $5. And hence the actual P by E that the stock was trading at based on expectations was actually 20 times. However, those expectations got lost and the actual reported number which has been saved is $20. So looking back, we can only say that $100 was the stock price, $20 was the earnings that year. Hence the PE ratio that the stock was trading at on January 20th, 2002 was 5 times. Is that correct? It's not correct because at this time people didn't know that the EPS will come out to be $20. Expectations actually were quite subdued. The stock outperformed is a separate occurrence. Hence, ex post data may underestimate ex ante risk because we are analyzing ex post data when everything is available. We are ignoring the fact that investors at this time did not have this data. So do not argue that 5 times is a fair multiple of stock will go down at, or you're expecting the stock to go down to 5 times, because actually this 5 times was never there. Data mining bias says that if you beat the data, some relationship will come out. But that doesn't mean that that relationship has statistical significance or it has economic use. These may even be relationships due to random chance. Conditioning information may be ignored. So after doing all these analyses, you should tweak your analysis to the specific circumstances that you are in. If you're not doing that, again your estimate may be incorrect or misinterpretation of correlations. So just because there is a correlation between rainfall in New York and accidents in Mumbai doesn't mean I will increase the number of policemen on the roads when it is raining heavily in New York. So it is possible that if I calculate the rainfall in New York statistic and the accidents in Mumbai statistic, the correlation comes out to be 1 or a very high correlation exists. So remember, correlation does not establish causality. The causality comes first, common sense comes first, and you can use correlation to support your thesis or to argue your thesis, but nothing more. The 8th limitation is very interesting. It says that forecasters and researchers themselves suffer from psychological traps, which may cause error in the forecasting. The anchoring trap is the same as the anchoring and adjustment bias. That is, we place more weightage on our original forecast and do not account for the new information as well as it should be. The status quo trap says unless forced, we would prefer to do nothing, or we just don't change our estimates. Confirming evidence trap says that researchers actively seek out data point that supports their theory, and hence they are more likely to make a mistake as they ignore information that contradicts their analysis. Overconfidence trap. Researchers give the range of expectations too narrow. The best case and the worst case expectations are too narrow an interval, suggesting overconfidence. Researchers need to analyze, or they need to realize their limitations and give a broader range of possible outcomes, because there are so many things that are not in their hands. So these are pretty similar to the biases or to the corresponding biases that we studied earlier. The prudence trap says that researchers and analysts avoid making extreme forecasts, or they try to be close to consensus. Because if everybody goes wrong, the feeling of regret is not as bad. But if you were the only one who was far away from the consensus and you go wrong, then there will be a high feeling of regret. This comes from the regret aversion bias. Recallability trap is when experienced analysts and even other analysts let past disasters weigh too heavily on their original or on their current forecasts. So they are just not able to let go of the past, and hence they often miss opportunities because they are conditioning too much, or they are still scarred by the memory of that big disaster or big downfall or a big loss that they had. The last problem with forecasting is of model and input uncertainty. So which model to use, which distribution to use, should it be the normal, the log normal, or something else? And how reliable is your data going into the model are all question marks to some extent and may cause problems with your forecasting and your calculations. Various tools can be used for forecasting. So we will first study statistical models, wherein you can start by simply projecting historical data. That is, take the average of the last 10-year returns and use that as your future return. Take the average of the last 20 years data and use that as your future. You can also use shrinkage estimators that are basically a weighted average. So you may want to place a higher weight on recent data, a lower weight on past data, so on and so forth. We studied time series analysis at level 2 that can also be used to predict our returns in the future. If we have the time and the resources, we can try to construct multi-factor models like the no arbitrage pricing theory that we studied at level 2, wherein the return on a particular stock can be calculated from a regression analysis as dependent on various factors. Beta 1 is the sensitivity to factor 1, beta 2 is a sensitivity to factor 2, so on and so forth. If stock 1 has a sensitivity of beta I1 to factor 1 and beta I2 to factor 2, and I know the standard deviations of factor 1 and the standard deviations of factor 2, then the risk of stock 1 can approximately be estimated as beta I1 square F1 sigma F1 square, beta I2 square sigma F2 square, plus 2 beta I1 beta I2 covariance of F1 and F2 plus some idiosyncratic risk of stock 1. So the market risk of stock 1 can be estimated by this equation. F1 can be any factor. So if I'm projecting the return of a global portfolio, F1 can be the return on the Indian equity markets. F2 can be the return on the US market. So this is a portfolio that is invested in US and India. So if I know the standard deviation of the Indian market and the standard deviation of the US market, I can approximately calculate the risk of my individual stock. If I have two portfolios, both of whom are levered to the Indian and the US markets, but have different factor sensitivities, and the factor sensitivities again have been calculated as our beta J1 and beta J2 for stock 2. So there's another stock, RJ, for whom there's a different alpha, there's a different beta, and there's a different beta or a different sensitivity to the second factor as well. If I've calculated these two betas, then the covariance between stock I and stock J can be calculated from this equation. So you do not need to memorize the two-factor model equations, but we will soon study the one-factor simplifications for both these formulae. That is when the stock returns are dependent on only one factor rather than two factors. When we come to that, those you will have to remember. For now, it will suffice to know that if the factor sensitivities are given, then given the standard deviations of the factors, I can calculate the standard deviation of the portfolio or the stock, and given the factor sensitivities of two portfolios, I can calculate the covariance between the two portfolios, given that I have the standard deviations of the factors as discussed earlier. So computing the return on equity is similar to saying the expected return on a broad-based market index, something like the Nifty 50 or S&P 500. The expected return on equity is nothing but the expected return on these indices, or approximately equal to the expected return on these indices. If we know the expected dividends from these stocks, and we know the current value of the index today, and we also have an estimate of the sustainable growth rate in the index earnings and the index dividend till infinity, then we can apply the Gordon growth model to calculate the current value of the index. That is simply the expected dividend in the coming year upon the cost of equity or the required return on equity minus the growth. Since we know the current value of the index because it is observable in the market, I can calculate the expected value of the required return as the dividend yield plus the growth. So either forecast using statistical models. If you have data available, you can use a DCF type model. A very important model that the CFA level 3 curriculum presents is called the Grinold and Kroner model. The model says that return is expected from any index in two forms. Either you receive dividends from the market or dividends from the stock, or you get capital appreciation. Dividends is what the company chooses to share back with the shareholders, and capital appreciation is the increase in stock price that happens when investors see more value in the company. Investors will see more value in the company. Why? When either the earnings improve or the profitability of the company improves, or in the second case, earnings may not have substantially changed or substantially improved. However, the future outlook on the company has improved and the future outlook on the economy has improved. So for the same earnings, we are giving a higher multiple. So capital appreciation will happen either if profit grows or if the PE multiple increases. So Grinold and Kroner say that the total return on equity or total return on the stock is the dividend yield, that is simply the dividend the company pays. Some companies don't pay dividend, they do a share buyback. So share buyback is thought similarly as the dividend yield. It will also cause corresponding amount of capital appreciation. So the first two terms is the money given directly back by the company to the shareholders. I plus G, that is the second term, represents nominal earnings growth or earnings growth. I is the inflation and G is the real growth rate in the economy. So for an average company in this economy, prices of goods and prices of raw materials would have gone up to the extent of inflation. Hence, earnings would have gone up to the extent of inflation, plus whatever is the real growth or the volume growth in production and sales. So there will be a dividend yield and there will be an earnings growth. And return will additionally come if the outlook on the market increases and people are giving higher multiple. So the last term is called the repricing return or the change in PE multiple. So remember, the first two terms, that is the dividend yield minus the repurchase yield or minus the stock repurchase, is called income return. The next two terms are called nominal earnings growth. They feed into the capital appreciation. And the repricing return is the change in multiple, will happen if the outlook on growth improves, and is called the repricing return. So just to summarize, the Grinold and Kroner model says that if we are to forecast the return on equity, forecast the dividend yield, forecast the amount of repurchase that will happen. If repurchase happens, delta S will be negative because the number of shares will go down. So delta S is the change in the number of shares outstanding. So if this is negative, the yield will become positive. If you issue shares, then there will be an increase in the number of shares and this number will be positive, hence reducing your return. I plus G is the earnings growth and delta P by E is your repricing return. Earnings growth and repricing return will go into the capital appreciation part of the return. And so would delta S. So delta S, earnings growth, and delta P by E would go into giving you capital appreciation, whereas dividend yield would be in the form of current income or current yield. But remember, dividend minus delta S is income return, I plus G is nominal earnings growth, and delta P by E is repricing return. The next approach says that to estimate the required return, you can simply start with the risk-free rate and add a premium for all the risks that you're facing. So add a premium for the inflation risk, for default risk if you're investing in corporate bonds or corporates, liquidity risk premium because corporate bonds will generally be less liquid than government bonds or the risk-free securities. So you'll have to add a liquidity risk premium. If you're in a long maturity bond, then it's generally seen that these bonds have higher risk than shorter maturity bonds. So you may want to add a premium for that. If you are a heavily taxed bond or if you have tax advantages, then you may want to add a tax premium to compute your required rate of return or the expected rate of return on a particular security or a particular asset class. So this kind of approach is more used for estimating the return of fixed income asset classes or fixed income securities. The next category of prediction models deals with financial equilibrium models. So we studied CAPM at level 1 and 2. The international CAPM at level 3 is the same equation essentially that says the expected return on the stock is nothing but the risk-free rate plus beta times the equity risk premium, that is the expected return on the market minus the risk-free rate. So expected return on the asset, RF, beta, RM. So beta is the systematic risk of the stock, that is the covariance of the stock with the market upon the variance of the market. This can also be written as the correlation of the stock with the market into standard deviation of the stock into standard deviation of the stock divided by the standard deviation of the market. So we're just going to rearrange this equation a little bit. So the expected return is the I cap M equation. If I bring RF on the left hand side, then the risk premium on the stock is nothing but the correlation into sigma I upon sigma M into RM minus RF. Or we can say that the equity risk premium for the stock is beta times the equity risk premium of the. We studied in the beginning of the session that in a two-factor model, if there are two stocks or two assets and both have different factor sensitivities to the two factors F1 and F2, then the covariance between stock I and stock J can be estimated using the following equation. If, however, there is only one factor, instead of F1 and F2, there is only one factor F1. That is, the return on stock I is also alpha plus beta I into M, and the return on stock J is simply alpha J plus beta J into M. So there is only one factor F1, not two factors F1 and F2. In such a scenario, the covariance between I and J would be given simply as beta I into beta J into the variance of the market. Approximately the variance of I will be given as beta I square into the variance of the market. Approximate variance of stock J will be given as beta J square into the variance of the market. The two-factor models, it's okay if you don't memorize these formulae, but for a one-factor model, please try to remember the formula for the variance of an individual asset and the covariance between two assets given the factor sensitivities to the one factor. In this case, the one factor is the return on the market. A market will be called fully integrated if there are no restrictions on capital flows. Anybody can invest in that market. An investor in this market can invest in any other market in the world. Then this will be called a fully integrated market. In a fully segmented market, there is no exchange of capital. So nobody can invest in this country, and investors in this country cannot invest outside into any other country. So there are no flow of funds into or out of a segmented market. A lot of markets like India will fall somewhere in between the two. So neither are they fully integrated nor are they fully segmented. There is some degree of integration. Now for a global investor, if he is analyzing investments in a particular country A, in a particular stock I, when he computes his beta, or when he computes the beta for this stock I, he would calculate the covariance of stock I with which market? The global market or the market of country A? So the investor in the global markets will consider the correlation and the covariance of stock I with the global market, because he doesn't care about this index. He's not borrowing in this country. He's not investing in this country. His funding is happening globally. His benchmark is global. He wants to diversify his global portfolio. He doesn't want to diversify the Nifty because he's not holding anything in the Nifty or in that local market. So he will see the correlation between the stock I and the global market. So the beta of this stock J will be calculated by the correlation and the covariance with the global market upon the variance of the global market. Now the beta can always be calculated, whether A is a segmented market or it is an integrated market. The calculation of beta can always be done. Beta will be the covariance upon the variance. However, if A was a fully segmented market, would this beta have much meaning? Or rather, would this low correlation have much meaning, assuming there is a low correlation between the global portfolio and stock I? It would not, because there are no funds flowing between the markets, so there is no way you can invest. Hence, a low correlation would not have much meaning, even though theoretically the beta is going to be quite attractive and theoretically the correlation is going to be quite low, because to series we can always calculate the correlation whether or not investing is allowed or not. So remember, beta calculation happens the same way. However, when we are calculating the required rate of return for stock I, and if this stock I is in a fully segmented market, or let's say in a highly segmented market, then we will assume the correlation between I and G to be equal to 1. That is the highest possible correlation. That is, we would give no benefit of diversification, or we would get no benefit of the correlation with the global portfolio. So even if we are in this country and we somehow are able to invest in stock I, we know that this stock I will not be priced according to the correlation with the global portfolio, because global funds cannot invest and that low cost of capital can never benefit this stock. So countries which are integrated, or emerging markets that are integrated with the rest of the world, normally see higher stock prices. The reason is that the cost of funding for them would reduce, because they no longer have to depend on the 10, 12, 13% rates of interest that is existing in their country. If global funds are accessible, then the cost of funding can be reduced to the extent of the global cost of funding. However, if a stock is fully segmented, then that benefit is not available and the cost of funding would still remain high. So the required return on equity would be RF plus beta times RM minus RF. In the calculation of the required return on equity for a fully segmented stock, beta will be calculated assuming the correlation as equal to 1. For a fully integrated market, beta will be calculated using the regular correlation as derived by the covariance upon the product of the standard deviations. So let's do an example and understand this concept better. Mr. Henry Jackson is an analyst at ATI Financial Advisory Services. He is assigned a task of valuing New Zealand, a developed economy, and of Malaysia, an emerging market. The investor's time horizon is 5 years. The other pertinent facts are: Sharpe ratio of the global portfolio is 0.32. Standard deviation of the global portfolio is 11%. Risk-free rate of return is 3%. Degree of market integration for New Zealand is 90%. Degree of market integration for Malaysia is 60%. Standard deviation of New Zealand is 20%. Standard deviation of Malaysia is 34%. Correlation of New Zealand with the global portfolio is 0.87. Correlation of Malaysia with the global portfolio is 0.54. Illiquidity premium for New Zealand is 0, and an estimated illiquidity premium for Malaysia is 3.5%. Calculate the assets, expected returns, betas and covariance. So essentially calculate the expected return of the New Zealand market, the expected return of the Malaysian market, and the correlation and the covariance between the two markets. Now, the first part is to calculate the expected return. So if we need the expected return, we will first resort to the CAPM equation to give us the answer. So the expected return is nothing but RF plus beta times RM minus RF. If there is an illiquidity premium specifically mentioned, we may want to add that as well for a particular economy. Now the problem, however, is that between integrated and segmented markets, this calculation of beta may vary depending on what correlation assumption we are bringing in. The way we account for the degree of market integration is that we first compute the expected return assuming full integration. We then compute the expected return assuming full segmentation. And then we take a weighted average taking into account the degree of integration for a particular stock or a particular market. So let's first compute the equity risk premium for New Zealand assuming full integration. So assuming full integration, the equity risk premium would be nothing but beta times RM minus RF, where RM is the global portfolio. Beta will be calculated using the regular correlation coefficient, which is quite high, that is 0.87. So it will be 0.87 into the standard deviation of New Zealand, which is given to be 20%, divided by the standard deviation of the market, which is given as 11%. The equity risk premium is not explicitly given. However, we are given the Sharpe ratio of the global portfolio. Sharpe ratio is defined as RM minus RF upon sigma M, which is equal to 32%. So Sharpe ratio of the global portfolio is given to be 0.32, or RM minus RF can be estimated as 0.32 into the standard deviation of the market, that is 11%. So RM minus RF will be 0.32 into 11%, hence the 11 will get cancelled, or the equity risk premium assuming full integration for New Zealand would be equal to 5.57%. Next step is to calculate the equity risk premium for New Zealand assuming full segmentation. So assuming full segmentation, we will work as though the correlation coefficient is 1, that is, we are giving no benefit of the low correlation, since we cannot invest and in any way exploit the benefit of a low correlation. So the equity risk premium will be calculated as correlation coefficient, that is 1 into 20 by 11 into 0.32 into 11, that is equal to 6.4%. New Zealand doesn't have any illiquidity premium. If there was an illiquidity premium, we could have added it to the equity risk premium right here, or we could have added it right at the end. Both would have given us the correct answer. The question then mentions that the degree of integration for New Zealand is 90%. Hence, the equity risk premium for New Zealand will be calculated as 0.9 into 5.57 plus 0.1 into 6.4 as equal to 5.65%. We then need to replace this in the CAPM formula to calculate the expected return on the stock. So basically we just need to add the risk-free rate to this calculation to calculate the expected return on the stock. So RM or RI minus RF is given to be 5.65. So the expected return on the New Zealand market is 5.65 plus the risk-free rate, that is equal to 3%, or a total return of 8.65%. So let's do the same calculation for Malaysia now. We will first do it assuming full integration. So with full integration, the equity risk premium for Malaysia would be equal to the correlation, that is 0.54, into the standard deviation of the Malaysian market, that is 34%, upon the standard deviation of the global portfolio, that is 11%, into RM minus RF, that is nothing but 0.32 into 11%, as we calculated in the New Zealand example. So assuming full integration, the equity risk premium for the Malaysian market, excluding the illiquidity premium, would come out to be so much. Adding the illiquidity premium as well, we will get the equity risk premium assuming full integration as 9.38%. Similarly, for Malaysia, assuming full segmentation, that is, we would give no benefit of the correlation. We will assume the correlation to be equal to 1. The equity risk premium now will come out to be 1 into 34 by 11 into 0.32 into 11. That is basically 34 into 0.32, which comes out to be 10.88 plus the illiquidity premium of 3.5, which will give us the total equity risk premium assuming full segmentation as 14.38. Please note that this is logical, as if you are not integrated, then you will not have as much investment into your country. Your discount rates will be high because you are only, or your cost of funding will be, the local cost of funding will be much higher, and hence the required rate of return will be much higher. The question says that Malaysia is 60% integrated with the global market. Hence, the equity risk premium that we will use will be 60% into 9.38 plus 40% into 14.38 as equal to as 11.38%. Now, if the risk premium is known, then the return on the Malaysian market will simply be 11.38 plus the risk-free rate of 3%, that is equal to 14.38%. So that's the first part of the question, the one that asks us to calculate the expected returns. Please note the beta calculation doesn't change. So beta is a mathematical calculation that is simply equal to correlation into sigma I upon sigma m. So that will remain as 0.54 into 34 by 11 for Malaysia and 0.87 into 20 by 11 for New Zealand. So that will be the two betas. Please note that this is a one factor model. Both countries are exposed to the global market as the risk factor. So as the global market returns vary, the returns on these stocks vary to the extent of the beta. So in a one factor model, the covariance between two assets or between two stocks dependent on that same factor is given as beta 1 into beta 2 into the variance of the factor. So in this case, the covariance can be calculated as, so beta 1 for Malaysia comes out to be 1.6691 and beta for New Zealand comes out to be 1.58. So the covariance between the two would be 1.6691 into 1.58 into sigma m square, that is 0.11 square or 11 square, approximately 0.0319. The curriculum then says that if nothing else is working and you don't have any resources whatsoever, you can just take the help of surveys and judgment. So ask 10 educated people what they think will be the stock market's return this year or the bond market's return this year, and use that as your expectation for capital markets. So surveys from market participants, economists, analysts, other prominent and related people. This is called the panel method of estimating the capital market expectations, and you can then condition it based on your own experience and insight to compute and increase the accuracy of your forecasts. If you were using a DCF based model or the Grinold and Kroner model, one input that model requires is the expected growth rate for the sustainable future or the expected growth rate for the next year. That real growth rate is generally taken to be the same as the GDP growth rate. And if we dissect the GDP growth or the economic growth, we see that it comes from two aspects. There is a trend growth, and then there is a cyclical growth that affects that long-term trend. So if we see the world's GDP has been increasing with a cyclical component, however. So there have been periods of high growth, periods of low growth, and so on and so forth. This trend growth rate depends on fundamental factors: productivity, labor force increase. This cyclical growth rate depends on cyclical factors that we'll just study. So we've seen that there are inventory cycles and business cycles. Inventory cycles are relatively shorter, 2 to 4 years, and we found that the inventory to sales ratio increases during periods of high growth as businesses anticipate good demand in the future. So as inventories increase, more production is happening, more people are employed, unemployment is low, economy generally is better. Until when the reverse happens and the anticipation of future sales is bad, hence entrepreneurs do not add to their inventory. They do not produce more, rather they sell out their existing inventory, and when we get more unemployment as production is not happening. The business cycle is generally longer and has certain other characteristics as compared to the inventory cycle. So it has 5 phases that we will just see in the coming slide. To measure economic activity, it is generally the GDP of the country and the growth rate in GDP that we check. The output gap is another important metric, that is simply the current GDP minus the forecasted trend GDP. Recession is defined as 2 consecutive quarters of year-on-year GDP decline. So we'll now look at the 5 phases of the business cycle. Initial recovery generally has a duration of a few months, wherein business confidence is rising. Government stimulation is provided by low interest rates and budget deficits. So we are in the initial recovery. Interest rates, remember, are still low, and government is still in a budget deficit or still increasing budget deficits. Inflation is falling. Low or falling short-term interest rates. So these would normally be the same direction as inflation. Bond yields have bottomed out, or interest rates are at their lowest. Stock prices start to rise during an initial recovery. After the initial recovery, we generally move into the early expansion phase, which can have a duration of a year to many years, wherein we see increasing growth with low inflation, increasing confidence, increasing inventories, rising short-term rates, flat or rising bond yields, and rising stock prices. So in the early expansion phase, the economy has started to recover. Going by the characteristics, what would be a good investment in these 2 phases? So if you anticipate an initial recovery or an early expansion, then You should try to get out of fixed income instruments and bonds as interest rates have already bottomed out or are about to bottom out. Stock prices have started rising. Commodities have started rising. Real estate is going to be a good investment. So in both these phases, generally riskier positions, cyclicals, real estate, stocks is where your portfolio should be focused on. And you should have lesser investments in bonds and fixed income instruments. Please note, it may often be difficult to tell between the two. A lot of the factors are common. So both initial recovery and early expansion will see business confidence rising. Both will in fact see increasing inventories also to some extent. Please note that in the initial recovery phase, interest rates are still falling and government is still providing stimulation. In an early expansion is when you see that reversing a little bit. So you see short-term rates increasing a little bit. And bond yields have definitely bottomed out. So they are flat or they have started to marginally increase. So it will be tough to tell between the cycles, and questions often may ask that what stage in the cycle do you feel this economy is, and hence what would be an appropriate investment at this stage. In a late expansion, we see that confidence and employment are high. Inflation now has definitely started to increase. Central bank limits the growth of money supply, so is basically increasing interest rates, or monetary policy has now become restrictive. Rising short-term interest rates, rising bond yields, rising stock prices, but risk is increasing with investor nervousness. So a late expansion will differ from an early expansion in that inflation and rising yields are certainly happening now. So bond yields are increasing, short-term rates are rising, central bank is following a tightening, or he is limiting the growth of money supply. So it will relatively be easy to tell a difference between a late expansion and an early expansion or an initial recovery. After the late expansion, we start slowing down. This can have a duration of a few months to a year or longer. There's declining confidence, inflation is still rising, falling inventory levels, short-term interest rates are at their peak, bond yields have peaked and may now start to be falling stock prices is what is generally seen in a slowdown. So a lot of similarities with the late expansion, interest rates rising, inflation rising, bond yields may have started to fall would be some indication. Falling stock prices would be a big indication that you are in a slowdown and not in a late expansion. So if the case slide anywhere mentions falling stock prices, then tilt will definitely be towards slowdown or a recession. From the slowdown, we move to a recession, which can have a duration of 6 months to a year, characterized by large declines in inventory, declining confidence and profits, inflation peaks out, interest rates have now started to fall, falling bond yields, rising bond prices, people move their assets to fixed income securities because they don't want to be in stocks, stock prices are falling, stocks have given loss in this last year or so between the slowdown and the recession. We may find that stock prices increase during the later stages of a recession, anticipating the end of the recession. So please try to memorize the characteristics of the 5 phases of the business cycle that can have a length of 8 to 12 years, increasingly becoming shorter as we see from the economic data around us. But the 5 phases include initial recovery, early expansion, late expansion, slowdown, and recession. Please memorize the characteristics.